What's up you guys, welcome back to the Average Joe Investor channel. In today's video we are continuing our conversation on some of the best ways to create cash flow in your portfolio. Selling options is one of the best ways and one of the most efficient ways to generate a lot of cash flow. But what if the markets go down? Is this still a viable strategy? The answer is yes, you can generate a lot of cash flow and avoid losses. So let's talk about our traditional covered call strategy and where the issues can potentially come up. Let's assume we're looking at an investment and the current price is right here. And we'll call this, I don't know, $100. Traditionally, most covered calls will be written out of the money, meaning above the current strike price, so that you can collect both income and capital appreciation if the price goes up in value. So for example, if the current price was $100 per share, you might write a covered call at, let's say, right here. And let's say that that's at 103. Now in this scenario, if the market goes up in value, let's say, goes like this, comes around, then goes up, and it finishes right in this area right here at, let's call that 104. Well, then you're going to get assigned and you're going to lose your shares. But you get to keep the original option income and you still participated in all of these portions of the gains right here in capital appreciation. Nothing above the red line, but everything between the blue and the red line. But instead of going up like this price did, what if the market does something like this? It goes up and then it just goes way down here and ends at like 97. Well, you still get to keep your option premium. However, the price has dropped from 100 down to 97, and if 100 is your cost basis, then you're going to be able to collect a lot less option income as a result. You're then left with the predicament of choosing to not write options if the price is too far below your cost basis, or deciding that you're willing to take the risk of potentially writing covered calls below your basis and potentially getting assigned for a guaranteed loss of capital. So going back to our original scenario here, is there a way for us to set up a covered call wherein we can still capture some cash flow but also avoid losses if the stock price goes down in value? The answer is yes. What we're talking about are in the money covered calls. So in this situation, if we're sticking with a price of $100 per share, instead of writing options above 100, say at like 104 right here, instead of going up here, and instead of going even closer to 100, like at 103, 102, 101, instead we're going to write this option at 97 right here. Now this is the point where people start to get a little bit confused. So let's break it down here. Why would we do this? Why would we write an in the money covered call? Wouldn't this guarantee, number one, that we're likely to get assigned, and number two, to do so for a loss? Before we can continue with this conversation though, we need to have some fundamental understanding of two key terms when it comes to options, and that is intrinsic value and extrinsic value. By the way, if you have any questions, you're welcome to check out the Average Joe Investor Patreon community where you can learn more about what we're doing here, but also tap into the amazing Discord community, and potentially, if you're interested, take a look at the exclusive access or the VIP access as well to one-on-one time with me. If you want to learn more, check out the link down in the description below. Intrinsic value would be the value of the option if you took away any time value, meaning if the option were to expire today, what would be the value of the option? Would it be worthless, or would it have some level of value? There's a specific equation for this. Intrinsic value equals current market price minus your strike price. So going back to our 104 example here, let me just draw this line across right here. And let's assume that the market price here, we'll go here. Let's assume that the actual price starts at 100, goes like this, and here, ends below the strike price, ends at, let's say, 103. So then let's go ahead and break this down from a math standpoint. From an intrinsic value, okay, we would take the market price, which is 103, and we would subtract our strike price, 104, which is technically negative or 0, which means at this point, the option has no intrinsic value. And if today is the expiration date, it's also not going to have any extrinsic value as well. So how do we define extrinsic value? Extrinsic value is the value of the option based on how much time volatility is left. How much time is there for the price of the option, the value of the option, to change up or down in the future. The level of extrinsic value is highest when you first purchase or sell the option, and it goes down every single moment after that. The technical formula here is going to be option contract value subtracting intrinsic value equals your extrinsic value. So the option contract is made up of two values, extrinsic value and intrinsic value. The intrinsic value, again, is the value of the option based on what its value is right now if it was at expiration. And then the extrinsic value is the value of the option based on how much time volatility is left. Okay, so going back here to our option contract, looking at our example here. So here's what we talked about intrinsic value and extrinsic value. When we first sell this option at 97, let's talk about our extrinsic value, which I'll just say is EXT, and then we'll talk about our intrinsic value, INT. Now again, intrinsic value is the current strike price minus the market price. So in this situation, if we just sell the option here, we would take market price 100 minus strike price 97, meaning when we first sell the option, it already has extrinsic value of $3 per share. And we also know that this option must have some level of extrinsic value because we just sold it or purchased it, and there is some level of time left until expiration. So let's make an assumption here. Let's assume that this was a 7-day option, okay? So the time frame here from here to here-ish is 7 days. And when we sold this option, we received option premium. Let's just assume that that level of option premium was $5 per share. Okay, so our extrinsic value is going to be our total option value, 5, minus our intrinsic value of 3, which equals $2 per share extrinsic value. Now, when you sell this option, okay, at the beginning of the time frame here, what we're essentially doing is we're locking in. If the market price is above 97 at the expiration, then we are going to get assigned. And not only are we going to get assigned, we're going to get assigned at that lower price, $97 per share. So if we're going to get assigned at 97, and let's say the market does nothing, it's just, modulates here between 101 and 99, and it ends up ending at $100 per share. It goes here, it goes down, and then it ends right here, right smack dab at $100 per share. So it ends at 100, the market price is 100, but we're selling it for 97. Why is this a good deal for us? What happened here to make it add some value for us as an option seller? Remember, even though it was in the money by $3, we actually received $5. In other words, that intrinsic value of $3 we are compensated for at the very beginning. Let me just show that here with the map and put the yellow on. This area right here between 97 and 100, when we were first sold this option, we received $5, not $3, not $2, which means we were given credit for that lower strike price right at the very beginning. We received that part of that intrinsic value of $3 gives us or represents that value that's already inherently built into the option. So if the market, instead of being flat at 100, were to drop to, let's say, 97.05, well then at the option expiration we'll still get assigned, but we've been compensated for that drop from 100 down to 97. It's a way for us to avoid losses. Now of course the market could drop below our strike price, in which case there's going to be an end to how much value we can get of this in the money option, but we're still compensating ourselves for a loss below the current market price. Now you can continue, you can go even further below 97, you can go 96, 95, 94, and you will get compensated for that intrinsic value, though the lower or the deeper you go in the money, the less time value is going to be available. Okay, so now that we fundamentally understand what's going on with the in-the-money covered call, let's look at some real-life examples to see how can we use this strategy to actually generate cash flow and avoid losses. First, we'll take a look at QQQ, and then we'll look at the Russell 2000 IWM. So QQQ, the NASDAQ 100 here, currently priced at $4.40 per share. Let's take a look at the option contracts here, the option chain. So first off, let's take a look at the 30-day option, then we'll look at a 7-day option, and then we'll look at IWMs here. So let's take a look at, let's see here, the 31 days to expiration right here is the best we can do. So the May 10, 2024, and let's actually open up to 20 strikes so we can show a little bit deeper in the money example here. Okay, so we're looking at the May 10th, 2024 expiration. Again, current market price is $4.40 per share. And the current at the money price is right here between 440 and 441. So let's just assume that we are writing options, we're selling covered calls, and we're generating cash flow, but we're starting to get a little bit concerned about potential downside price action. And we want to insulate ourselves a little bit from any downside risk in the markets. Let's say we wanted to protect ourselves for the next 30 days for a price drop of 440 down to 435. So let's say we wanted to sell the in the money covered call at 435 right here. Okay, 435 would be our strike price. 440 and 60 cents is our market price. And for this option, if we were to sell it for a 31-day time frame, we would receive somewhere between $1,417 and $1,435. So we'll call it $1,425 for a round number. So how would this work out? Let's go ahead and go back to our graph. We've got our 440 market price right here and our 435 strike price. And in this situation, the option price, the amount of money that we received to sell this option was $1,425. But let's see how that 1425 breaks down in value at the beginning of the time frame. Remember, intrinsic value is going to equal our market price minus our strike price here. So the market price is 440, okay? We'll subtract our strike price, 435, which would equal intrinsic value of $5 per share. And then extrinsic value, which would be our option price, 1425 per share, 25, minus the $5 per share intrinsic value, which would equal $9.25 per share extrinsic value. In other words, this $5 per share extrinsic value right here is represented by this value or this area right here that we are being compensated for at the very beginning of the time frame when we sell the option. But this is not the entirety of the value we get, because we also get extrinsic value because there's some time left for the market price to do whatever. It can go up, down, sideways, we don't know. So we get compensated for that uncertainty. So in this situation, at the beginning of the time frame, if we sell this option, we're going to receive $1,425 per share, but some of that assumes that we're going to get assigned below the current market price of 440. So if the market were to do something like this here in purple, go up and come down and then end right in this area here, that is one of our best case scenarios because we were compensated not only for that $5 range, but also above and beyond that. And technically the market could go all the way down here and end at 435, and we would be fully made whole at this level because the strike price was so deep in the money. Now the downside of this strategy is obviously if the market goes up in value, you don't get to participate in any of the growth here aside from the option premium that you receive. So this can be a little bit risky if you're needing your capital to grow, but the reality is from an income standpoint, the compensation is significant and is something that we prioritize over capital growth. So in this situation, even if the market drops, you are protected all the way down to 435 plus the extra option value that we receive for extrinsic value or the time volatility. It's very possible that the market could go down below 435, at which point your covered call would no longer have additional value for you above and beyond what you've already received. Just to make sure we're clear here, so the time volatility would be the part that we would count towards our income, not the actual intrinsic value option volume here. So 1425 was the option premium minus the initial 5, so 925 or $925 would be how much we would receive in this specific situation for the month. Let's say we wanted to collect $3,000. We need to take 3,000 divided by 925. I mean, we need to have 3.24 contracts, or essentially 4 contracts, or approximately $165,000 to generate $3,000 a month in income monthly and have some downside protection. Here's the 7-day option for QQQ, expiring April 16th. We'll look at the same, we'll look at 436 right here. So 440 is the current market price. We want protection down to 436. We collect approximately $785 right here. It'd be the current market price, 440.60. And then subtracting 436 would be total intrinsic value of $4.60 per share. And we would just subtract here 7.85 would be about $325 in time volatility value. And let's assume that's the amount we would keep as income. And so we'll take 325 times 52 weeks divided by 12 would be about $1,408.33 from just one contract. So you could nearly meet your goal with just 2 contracts, though you might need a third to give you a little bit of a buffer. And honestly, you could even write this on a daily option standpoint here. So let's go back here. Let's say you wanted to have compensation or some protection down to 438, which is for the 1 day. It's $2 below the current market price. So in order to figure out our extrinsic and intrinsic value here, we would take the current market price, 440.60, and subtract 438 would be $2.60 intrinsic value. But we were receiving not 260, we were actually receiving 464 approximately here. So we'll subtract 464, which means we're actually being compensated $2.04 in option premium to write in the money by $2 and considering the time volatility left with the 1 day. So $204 here. Let's assume we can do that 22 times. I mean, that's $4,488. And even if the option premium was a little bit elevated for today, then let's assume we could only collect, I don't know, $150. So 150 times 22. Still $3,300 here, more than enough. Let's take a look here at IWM here. And we don't have a 7-day option here. We have a 6-day and an 8-day. So we'll go ahead and take a 6-day to be conservative. And we'll also look at 20 strikes to give ourselves a little bit more space. So if the current market price is right here, 205.57, right in between 205 and 206. And let's say we want protection over the next 6 days of $3 per share, down from 205 down to 202. So 205.57. is our market price, 205.57, subtracting our current strike price, which is 202 in this situation. So 357 is our intrinsic value. To calculate our extrinsic value, it would take the option value, the contract value, which was about $4.90 per share. So $4.90 minus 357 equals $1.33 per share extrinsic value, which per contract would be $133. We take 133, multiply that by 52, divided by 12 would equal approximately $576.33, which would be the actual income. If we wanted to collect about $3,000, we would take $3,000 divided by 576. We need about 5.2 contracts. We'll round that up to 6 contracts. 6 contracts or 600 shares times the current price, 205.43. Need to have about $123,000 to operate this strategy in order to collect $3,000 in income we could use. Now, option volume and volatility is going to differ from day to day, so no guarantees that these values we're looking at now are going to be translated into future income as well and future situations that you would experience. But the point here is that when you write in the money covered calls, you do give up capital appreciation, but you are compensated for that downside, that difference between the current market price and your strike price, and you also get additional time volatility. This can be a great strategy to complement what you're already doing with other investments and specifically with covered call strategies to make sure that, yes, you're capturing as much income as possible, but you're also giving yourself a little bit of leeway, especially if you're currently experiencing market all-time highs. Now, I recognize that this strategy is a little bit more complicated than what we've been talking about, but if you have any further questions, make sure to check out the Average Joe Investor Patreon community. You can get access to the collection of community members who are average Joe investors themselves. You can also sign up for a specific tier, the exclusive access or the VIP access to get one-on-one time with me to make sure you have the tools necessary to get acclimated and start investing in your own portfolio. Hopefully you found some value in this video. Make sure to leave your 2 cents down in the comments below. It's my goal to respond to as many comments as possible on the day I post a new video. That's all I got for you guys. Have a great rest of your day, and thanks for watching.